Good morning, everyone. Welcome back to our webinar series, An Integrated Approach to Strategic Pension Liability Management, presented by the California Debt and Investment Advisory Commission. I'm Robert Berry. I'm the Executive Director here at CDIAC. If you remember last week, our presenters covered how the municipal analyst world outside your agency views the pension challenge. They covered the fundamental mechanics of pension plans and actuarial methods, and finished with an overview of the tools and strategies that an agency can use to take a proactive pension management approach. So in today's session, we'll pick up right where we left off last week, discussing first how the strategies introduced last week are used, the conditions and circumstances where the strategies make the most sense, and then how they may be integrated potentially for greater effectiveness. Then the program will speak to the considerations for creating pension management policies. These can provide resilience through the variety of inevitable changes in economic conditions, fundamental plan policies, and assumptions. That will take us through about the first 60 minutes. And then for the last third of the program, we'll hear from three executives from three very different local agencies about how they approach their pension challenges, the process they went through, the strategies they used, and then the results they achieved. So I know you're all anxious to get started with the program. But if you allow me to quickly review some of our housekeeping items, especially for those of you that were not online last week. All right, the slides, again, we always get questions about where are the slides. They're available in the link in the handouts section of your GoToWebinar control panel. We've also posted them to our website now, both sessions. Your questions, please use the question box in the control panel to submit your questions at any time during the program. We have time planned for questions just after Mike's presentation and at the very end of the program as well. Captioning, we have a captioning service that's accessible through the linked address in the chat section of the control panel. If you participate in 70% of the webinar, we will send you a certificate of attendance in a couple of weeks. And then also in about 2 weeks, we'll have a full replay of both sessions of the program available in CDIAC's education portal. And then finally, if you have technical problems, GoToWebinar can help you at the number or the link on the screen. Now, it's again my pleasure to welcome back our faculty presenters for this session, Pension Management Strategies Applied. First, I'm pleased to reintroduce Todd Towser. Todd is a Senior Vice President and Actuary with Siegel. He specializes in public pension fund management, public pension fund funding, risk management, and plan sustainability as Siegel's National Public Sector Retirement Practice Leader. Prior to Siegel, Todd was the Director of Municipal Pensions at S&P Global Ratings and a Senior Pension Actuary at CalPERS. Then joining us again this morning is Mike Meyer. Mike is a Vice President at NHA Advisors, where he manages NHA's Pension and Fiscal Sustainability Group. Mike's team helps agencies to evaluate the benefits and risks of pension cost management strategies tailored to their unique needs and circumstances, with the goal of achieving long-term fiscal sustainability. So now Mike will be our lead presenter this morning, but Todd has agreed to come back and help us with subjects or questions where his background and expertise can be especially applicable. So please keep Todd in mind for your questions during the program as well. So we had a number of very good questions last week. There were a few that we didn't get to, so I'm going to turn it over to Mike and Todd, and they will take up these questions before getting started with the new material. Mike, Todd?
Thank you, Robert, and good morning, everybody. Nice to be here again. Just to jump right into the questions, the first one being what happens when municipalities face extreme situations that affect the pension funding, such as large wildfires, earthquakes, and large lawsuits. Great question. A lot of ways we could answer that. I will take this opportunity to direct whoever asked this question to our website. We have a section called NHA Alerts. These are newsletters that are relevant to topics of concern for public agencies. And our most recent one from April has to do with this exact question in terms of extreme weather events. Has a pretty good case study on the Town of Paradise rebuild we've been part of, as well as how they funded their pensions during that process. Obviously, some general fund money as well as settlement money. But generally speaking, we kind of see all of these as potential risks that need to be planned for. So whether it's growing UAL, extreme weather events, potentially economic events like losing a big retailer in your town and impacting sales tax. These are all things that can be communicated to your stakeholders as potential risks down the road, and hopefully put policies in place to start building reserves that could be used if one of these situations does take place in the future. The second question related to how and when to use the 115 trust, I'm going to try to address that question in about 3 or 4 slides when we get into some sample analysis there. The third question on OPEB, we will not be talking about OPEB today just because there's so much to cover related to pensions, but potentially a topic for another webinar. And then lastly, I'm going to defer this question to Todd as it relates to employees working for multiple cities and how that might affect benefit levels. So Todd?
Yeah, thank you. Good morning, everyone. So this last question says, since pension payment is at highest salary, how is liability makeup with recipients working for multiple cities? So you can think of this most applicable at CalPERS. It's applicable at other systems as well, especially if you have reciprocity across different systems where salary can count across systems. But at CalPERS, if you have an employee that works at one place, then goes and works at another place, and let's say their salary doubles at the new place, well, that's going to result in a much higher liability on their pension calculation, not just at the new place, but it's going to apply to all of their service, including the old city as well, or wherever they're working at before. And so a couple things to say about this. One is that when CalPERS is anticipating someone's future benefits and someone's future liabilities, they already apply what we call a salary scale to that person. So they anticipate that salary is going to be going up over their career. So when you move from one place to another and your salary goes up, it's not actually that much of a shock. The time when it can be a real shock is when you get an extraordinary pay increase. Let's say you're getting paid $50,000, you go somewhere else, you're getting paid $100,000. The CalPERS salary scale isn't anticipating a jump like that. So they aren't anticipating your salary to go up so much. And so in that case, CalPERS is actually supposed to go in extraordinary changes in salary to figure out a way to apply the additional liability to the new city, to the place where the salary increase was given. And that additional liability also includes, of course, the incremental additions to their benefits that they're going to get on past service due to the new salary. So CalPERS is supposed to do that, and they have a whole process for that. I don't think we have time to get into all the details of that, but that's the basic idea behind how they handle salary increases that are significant in scale.
Thank you, Todd, for that answer. And now we're going to just jump right into the part 2, the pension management strategies applied. Try to get through this in about half an hour, and then we have some really great case studies for the participants after that. So as you recall, if you were on last week, if you weren't, those slides are available for download, but we did go through 6 of the more common cost management strategies, went through some of the pros and the cons of each strategy last week. Just to touch on these briefly before we get into some sample analysis for each one of these. Important to reiterate again, these are not mutually exclusive strategies. Most agencies use several of these at one time as part of a multi-pronged strategy. Also memorialize that strategy as part of a pension funding policy, highly recommended. We'll talk a little bit at the end of this section about pension funding policies as well. But just to briefly go through what each one of these are, again, the annual UAL prepayment is where you would, instead of paying your UAL monthly throughout the year, pay that entire amount up front. With CalPERS, that deadline is July 31st, and you do get a discount for doing that. The second strategy is a fresh start amortization, where you request a new level payment amortization shape from your retirement plan. The third strategy is an additional discretionary payment, also what's known as an ADP, where you just pay above and beyond what's required on that UAL and extinguish the principal and interest associated with that piece of your UAL debt. The fourth strategy, the Section 115 trust, which is a separate trust managed by a third party, not the local agency. Once those funds are in that trust, again, legally restricted to be used for pension or OPEB expenses. Fifth strategy, an internally held pension reserve, so still very similar to the trust, the 115 trust. It is another shock absorber, but this type of strategy would still be controlled by the local agency. And then lastly, the UAL restructuring or pension bond. So now to dive into each one of these, UAL prepayment, again, is something that 4 out of 5 CalPERS members do each year. I think it's been about 80% for the last couple years. The benefit of that is that you get a discount. So instead of paying monthly, if you pay it all up front, you get about a 3.2 to 3.3% discount on those funds. A lot of agencies use that savings through their policy as really a mechanism to set aside additional funds towards other strategies. So whether that strategy is a 115 trust or an ADP or something else, that could be something a local agency may want to consider. Obviously, don't want to deter people away from doing the UAL prepayment. The savings is a significant amount. It's very simple to kind of make this payment early in the fiscal year, but just to bring up some considerations for when you may want to think twice. Obviously, if liquidity during the fiscal year is a concern, whether it's from a credit rating agency concern or just an operational concern, you may want to think twice about sending that large chunk of money out the door early in the fiscal year if you may need it during the year. And then secondly, as we talked about last week, the effective benefit of the prepayment becomes a lot less when you make some assumptions on what you could be doing with those reserve monies in terms of investing those monies. So a couple of years ago, most agencies weren't earning more than 0.2, 0.3% on their reserves. The prepayment obviously made a lot of sense. Given where market interest rates are today, we see a lot of agencies earning 3, 4, 5 or above %, given where short-term interest rates are. And as you can see from either of these charts, the effective prepayment benefit becomes a lot less if you make the assumption that you can be earning these higher investment yields on those reserves and then just pulling that money out monthly to send to CalPERS. So as you approach 5% on the annual earnings rate, that prepayment benefit drops to under 1% from that 3.24% level. So again, not trying to deter anyone from doing the prepayment, but just something to consider given where the current market is and what you could be earning on those reserves if you didn't send it out early in the fiscal year. The next option that we discussed is a fresh start, or really a new amortization for that entire plan's UAL. So again, this would mean that all those amortization layers that Todd described last week all get collapsed into one amortization base, and that new payment schedule is level. A couple key constraints though that you have with CalPERS is that you cannot really extend the term of the payments. So the one thing you have to prove to CalPERS is that whatever year you choose for the fresh start, be it 12 years or 13 or 16 or 17, you have to show that those new level payments over that term are lower than the current schedule. And so this chart here with the gray bars is something we'll kind of recycle throughout the next several slides. It's kind of a hypothetical UAL repayment shape for a $100 million UAL, but a very common shape for public agencies with kind of that steep increase. And what we've charted here is just a simple 10-year fresh start option and a 15-year fresh start option. And just to really describe the key differences being that the shorter you go on the fresh start, very similar to a mortgage, shorter the term, your annual payments are going to be a lot higher. So you can see, there in 2024, that red line is a lot higher than that gray bar, but those payments are done much sooner. So the savings, there's a lot of savings in the out years. In this analysis, it's about $28 million, as you can see from the red column up on the upper right. If you go a little bit longer on the fresh start, so the 15-year, those annual payments are a bit more manageable. They're a little bit, they're at a lower level, but a little bit less savings than the shorter fresh start, about 7 million in this analysis. And so again, you can, lots of different options beyond what's shown in your CalPERS report, so long as when you model those payments out, they are lower than your current stream. The Next slide is something that's a little bit more nuanced and relates to the current market. And this is a shape that we're seeing a lot of for public agencies who issued a pension bond over the last few years. And so what we're seeing is that if you look at that bar chart, you see those UAL payments kind of prior to the pension bond issuance growing on that kind of escalation shape. And then a lot of agencies kind of put into place a lower debt service using that pension bond with level payments. And then that 21.3% year by CalPERS happened. Pension bond issuers got even a little bit more benefit from that 21.3 because of market timing. That's something we'll get into a little bit later in this section. And so a lot of agencies who issued bonds are seeing nearly zero, maybe minimal or zero payments for several years because they went overfunded. However, they will be seeing the impact of that negative 7.5 starting next fiscal year, and that's going to ramp up over the next 5 years, and you can see that in the gray bars. And so for some pension bond issuers, a fresh start to really get ahead of that ramp up base and just level things out for the next 20 years may be somewhat more feasible. If you look at this red dotted line where a theoretical new fresh start could be versus those teal payments in 2021, not that big of a difference from where those overall payments were just a few years back. So this situation, a fresh start might be easier to stomach from a budgetary perspective. Wouldn't be surprised if we saw some more fresh starts than normal in the next year or two. As I mentioned last week, fresh starts haven't been that popular due to the lack of flexibility. In discussions with CalPERS, it sounded like only about 10 to 15 fresh starts over the last couple of years, voluntary fresh starts, that is. At the bottom here in the bullets on the left, just kind of big picture, a fresh start might be a good option for agencies that feel very comfortable that you do have the budgetary capacity to absorb those near-term higher payments. And oftentimes you may have a board or a council that really wants to just lock in those higher payments now and not be dependent on perhaps another council or these decisions having to be made every year going forward to set aside additional discretionary funds. And I think you'll hear this from Tabitha in her case study at the end, why a fresh start for the city of Arcata made a lot of sense based on some of these situations. The next slide, slide 11, talking about the additional discretionary payment or the ADP. Again, we're kind of going to recycle this hypothetical repayment shape on this $100 million UAL here in the chart. But when you're considering an ADP, so essentially sending more money to the retirement plan to pay down UAL, you got to think about how much, also which plan it's going to. So obviously an ADP to a safety plan is only going to affect that plan. Likely those savings are really going to only impact the general fund, whereas if you're funding the miscellaneous, you're really spreading out those savings to general fund, but also other utility funds or other funds that may be contributing to that plan. Most agencies have dozens of amortization bases or layers that you can choose from. They have different shapes, they have different terms, and so you really will see the savings change as well as the new repayment shape change based on how you apply that ADP. So just something to consider, once you know how much money you want to send to the retirement plan, looking at how to best apply that is always helpful as well. And we just did a very simplistic comparison here of if an agency were to try to send $10 million to pay down $10 million of that $100 million UAL, show you the differences here in applying that to a shorter term base, so a 10-year amortization base shown in red here, and then a longer amortization base shown in green, or a 20-year base based on this example. And really the difference is that for the shorter the term, you're able to really focus all the savings in those early years and bring down those payments a little bit lower, as you can see in the red line. Whereas when you take out a longer term base, you have less savings in the near term, but more overall because you're spreading those savings out over 20 years. And you can see that in the chart, but also the table on the top right, about 19 million of overall savings in the longer base payoff, where it's only about 14 million under the shorter term payoff. But again, all those savings for the short term are in the next 10 years, which is something that may be important to an agency if shaving down that mountain peak is the most important versus maybe maximizing overall savings. Moving to slide 12, and on this slide, try to address that earlier question with regards to, when do you know, or how much do you use of the 115 trust to send to the retirement plan? For most agencies we are working with, the 115 trust has been really in a mode of building that trust to sufficient levels that an agency feels will help them smooth out those future payments. So again, last week we talked about the shape, the mountain peak that most agencies are facing, that's shown in the gray bars here. And so most agencies we've been working with have been trying to build this trust over the last several years and are going to look to continue building that trust over the next 3, 4, 5 years while the UAL payments are still at a more manageable and lower level. I think you'll hear a lot about this strategy in Edward's case study later with the city of Riverside. Obviously, the more you can get into that trust in the right now and over the next few years, a lot of agencies are looking to then pull out that money in this example in years 2028 through 35 and help smooth that mountain peak in payments, meaning that the general fund's not having to contribute the whole thing. You're able to withdraw money out of that trust to help make your annual payments and reduce the burden on the general fund. As to how much you need in there, it's very situational. I think for most agencies, they're trying to look at, what is that target right now that will give you the ability to smooth down that future peak to a more manageable level. And that dollar amount is different for every agency we've worked with. It's also something that needs to be recalibrated every year. As everyone knows, this UAL changes every single year. This shape is going to change. And so each year, I think it's a good assessment to figure out, do you have enough in the trust based on the current conditions? Do we need more? Do we have too much? Maybe we have too much, maybe we can start making ADPs because we don't need so much in that 115 trust. Those are all, I think, questions to ask each year as you reevaluate this strategy. Moving on to slide 13, for those agencies who don't have a 115 trust set up, we've listed some of the popular providers out to the right. I apologize if there's other providers beyond these 5 groups, but in our experience, these are the 5 providers that we have seen working across the state of California, and all of them a bit distinct in terms of some of what they bring to the table. And I think just things to consider when choosing a 115 trust provider are shown to the left here. Obviously, experience. Most of these companies have different fee structures, obviously different investment performance, and then also investment options. So different types of portfolio options across the risk spectrum. Some of these agencies offer more customization and flexibility versus, let's say, a cookie cutter portfolio. Some of these things may be more important to your agency than others. So just important to take a look at when deciding which firm is the best fit for your agency. Lastly, or talking about trust in general and really shock absorbers to smooth this future peak, the internally held reserve is something we're seeing a lot of as well. For some, given the high interest rate environment right now, they're using it as an alternative to the 115 trust. Sometimes it may be important to have an internal reserve if maintaining general fund liquidity is very important. We have a couple of situations we've seen where an agency has actually gotten penalized for having too much in a 115 trust when it's been almost detrimental to the levels of the normal general fund reserve. So if that's something, if liquidity is a big concern operationally or just from a credit rating perspective, keeping that money under the control of your agency may be something to consider, as opposed to kind of sending it off to locking it away in the 115 trust, or in a situation where you expect you may have other needs for that cash, so other priorities that may pop up, a little bit more flexibility there to move that money around. For most agencies we work with, though, the internal reserve is really part of a multi-pronged strategy. So really the kind of the first line of defense in terms of soaking up money throughout the fiscal year and really earmarking it towards pensions. And then at some point down the road, maybe when that reserve grows to more meaningful levels, or when you have bandwidth, or when maybe the market dictates, then deciding how to really allocate those monies from the reserve. Maybe that's to an ADP, maybe it's to a 115 trust, maybe a little of both. So just another way of earmarking these funds early, getting them socked away for pensions, and then really figuring out the strategy at a later time on how to best deploy those monies. So moving into the last strategy, we have a few slides related to the pension bond, just given how complex this type of bond structure is, as well as the risk associated with it. As we talked about last week, there was roughly 100 pension bond issuances from May of 2020 to I think the summer of 2022. Slide 15 just shows some of the common structures that were used. Nearly 4/5 utilize a pension obligation bond structure, about 12% a lease structure, and the remaining 10% were some sort of revenue or utility bond. Just quick distinctions between the POB and the lease. Obviously both paid for by general fund monies. Pension obligation bond, of course, no leased asset required, typically one notch higher on the credit rating from S&P, which means potentially a lower interest rate, but it does require a legal court validation process to be able to issue that type of bond. Lease revenue bond, no validation process required, and potentially more flexibility in how you can use those monies, when those monies need to be sent to the retirement plan, or what things you can fund with it. But again, it does require a leased asset, and it typically is one notch lower for the credit rating, at least from Standard & Poor's. Some of the benefits and the risks we talked about quickly last week. In addition to, depending on the market, lowering the interest rate on that pension debt, converting that UAL interest rate to a lower interest rate on the bond. Most agencies took advantage of this strategy to really reshape those payments in a more sustainable way. So most often in a more level fashion and at a lower level, so that there was more resiliency created to absorb future economic shocks or more UAL, things like that. The primary risk that we talked about last week is known as reinvestment and market timing risk. And this is really the core concern by the GFOA. It's why they don't recommend agencies issue pension bonds. And what it means is that savings, unlike a typical bond refunding, savings are ultimately dependent on the future investment returns of the retirement plan. And of course, those are unknown at the time of issuance. So what it means from a present value perspective is that there are positive savings so long as the retirement plan on average earns more than what you're paying on the pension bond. If they earn less than the rate you're paying on the pension bond over the next, let's say 20, 30 years, then there would be negative savings. So again, hard to predict. That's why we always recommend a risk assessment or stress testing process to really see what that situation would look like under more pessimistic scenarios in the future. And lastly here, the third bullet point, and I think Todd made a great point last week, a pension bond is essentially a large ADP. Anytime you give a large ADP to the retirement plan, your assets go up immediately. Any gains and losses over the first several years are magnified, and we saw this a lot over the last couple of years. So agencies who made a big ADP prior to the 21.3% year by CalPERS got those gains magnified, and agencies who made a large ADP prior to that negative 7.5%, those losses were magnified as well. So something, again, to take into consideration as well as model out. Just to communicate this kind of risk-reward continuum in a graphic form, on the x-axis at the bottom there, we've charted potential investment returns by the retirement plan, and then on the y-axis we have POB or pension bond interest rates. So really the main takeaway here is that as the interest rate on the bond is lower, or the investment returns by the retirement plan are higher, you can see those savings are much greater, represented by those green circles. They get really big out when you have low pension bond interest rates and high investment returns. But on the flip side, you'll see negative savings shown in red there as the pension bond interest rate goes higher, or you have investment returns by the retirement plan that are lower. And for this, we just used a range of about 4 to 9%. And as you can see on that y-axis there, the reason you're likely not seeing a lot of pension bond issuance right now is that rates are in that 6 to 7% range, obviously making that risk-reward calculus a bit more difficult to stomach if you were looking to do a pension bond right now, whereas rates during 2020-21 were often in that 3 to 4% range, oftentimes even lower than 3% for some agencies. Two more slides on the pension bond. This chart right here is again our $100 million UAL example. Current payments shown in the gray bars, and then potential pension bond restructurings using level payments at different interest rates. And we wanted to just run this kind of very simple analysis to show how, as you move from a higher interest rate to a lower interest rate, you're able to lower those annual payments and increase the potential savings. But another way to look at it is the lower the interest rate, the lower the annual payment, the more resiliency you're creating. And on the flip side, at the higher levels, there's not as much resiliency to absorb future impacts, because you gotta remember that if the retirement plan has underperformance in the future, more UAL is going to get added on top of these payments. And so at the bottom of this chart on the left here, very simplistic stress test we like to do, which really highlights the ability to withstand a large market crash in the very first year after issuing a bond. And what you can see here is that when the POB in the left column there is at 6%, there's really no buffer or no resiliency to absorb any underperformance by the retirement plan. So if there is any underperformance, those savings can go quickly negative very quickly. As the rates go down, so assuming a pension bond of 4.5%, by our rough calculations here, this structure could withstand kind of a first year market crash of around negative 11 to 12%. Before you would start to see negative savings. It would have to be worse than that. And then at the lower interest rates, that's where you have a lot more resiliency to absorb kind of a down year in the very first year after issuing that bond. And we calculate here about 23%. And that's why I think a lot of agencies looked at that period in 2021 and 22 as maybe a better time to take on that risk, knowing that there was more ability to withstand underperformance in the future. So very lastly, and I think this applies to all the strategies we've talked about, and I think what you'll hear from all the case studies today is how important stakeholder education is. Pensions in general is very complex, if you are ever going to look at a pension bond down the road, very important to communicate the complexities to your stakeholders. Lots of options to look at in terms of course, legal structures, but also the term, how much of the UAL to pay off, what amortization basis to pay off, what shape to put in place. All of those change the risk reward analysis that we were talking about in the stress testing that we would recommend. So again, very important to assess risk, not just from a present value standpoint, but to really model out the cash flows under different pessimistic scenarios with and without a bond. I think, in our opinion, a lot more important to see what those payments are for the next 10 to 20 years with and without a bond, assuming some pessimistic scenarios. And then lastly, if you were to ever move forward with a pension bond, trying to put in place some risk mitigation strategies, whether that's dollar cost averaging those funds into the retirement plan, locking away the near-term savings through policy so that you can redeploy those monies towards this pension challenge, and then also just making sure that the new repayment shape does have enough resiliency to absorb potential future economic shocks. So 2 more slides before we get into questions and the case studies, but we talked about the importance of a pension funding policy. Again, this type of policy is really to establish a roadmap on how your agency is going to address these ongoing rising pension costs in a more sustainable way. Also, really let your stakeholders know more about this challenge and have everyone be on the same page. Some of the objectives of the policies that we've seen, a lot of policies have target funding ratios, different goals for the funding ratio of the retirement plan. If you have a 115 trust, often these policies will detail kind of minimum and maximum amounts, or maybe a range you're trying to target there. Oftentimes we'll see this policy integrated with a agency's overall reserve policy, just to make sure that kind of the flow of funds and the prioritization of monies is spelled out, so that you're ensuring that your high priority reserves are getting filled and topped off first before kind of moving into, we call it more discretionary type things like paying more towards pensions. A pension funding policy is helpful with the credit rating agencies. You will get some enhancements on the financial management score. And then of course, very important to establish an annual review process of the pension situation, maybe through that policy. Some things we've seen in some agency pension funding policies in terms of how the resources are created to dedicate towards any of these strategies. Of course, all of these strategies except for the pension bond do require extra cash. And so really having a mechanism to earmark that cash is a huge goal. We've seen a lot of agencies kind of put a percentage to annual budget surplus, some that have actually used a certain percentage of a very specific revenue stream, whether that be a sales tax measure or a portion of property tax, also a portion of one-time monies, or even other savings streams like the UAL prepayment, salary savings, things like that. Also, spelling out how utility funds are going to contribute as well, specifically as that relates to the miscellaneous plan. And then typically the policies will include the types of strategies that you may use and what situations those might be used in. So of course the UAL prepayment, the fresh start, I think you'll hear this in one of the case studies that there's kind of the formal fresh start, and then there's a lot of agencies that will actually not do the formal fresh start with the retirement plan, but they will budget as if the fresh start payments had happened. And this gives you a little more flexibility, but if you can make those higher payments, you could always take that surplus and use it as an ADP to send to the retirement plan as well. I think some agencies refer to that strategy as a soft fresh start as opposed to a hard fresh start. If you're going to look at a pension bond down the road, putting guardrails around that type of strategy is often helpful. So minimum saving thresholds, spelling out the process that you would utilize to assess risk, whether that's with an actuary or your advisor or experts in that field. And then I think a lot of our case studies are going to touch upon some of the unique things that were built into their case studies as well, or their situations. So with that, I'm going to open it up, turn it over to Robert to see if any questions came in during the first part of our webinar.
Thanks, Mike. We had a question relative to the performance of the fund, the assumed investment return. And I think this goes to the amortization of the reamortization under a fresh start program. If CalPERS does better than the assumed investment return, what happens to the annual payments, especially under that fresh start amortization structure?
Yeah, so great question. So I think everyone keeps seeing these positive amortization bases being added when the retirement plan doesn't meet its mark. When CalPERS has a better year than assumed, like the 21.3% year, you'll see an amortization base added, but it's a negative. And so it's an offset to all those positive layers. And so that gets modeled out over a certain term. Obviously, when the new negative amortization base is added, there are negative payments over 20 years, and that offsets all the positive bases. So you are getting credit for that, whether you have a fresh start or not. So you are getting credit for the years when the retirement plan overperforms, and it just nets out of those positive UAL payments.
So I have a question relative to pension funding policies. You just talked about those, and you mentioned a little bit about the kind of political vulnerabilities, economic market vulnerabilities from market conditions changing. How often are pension funding policies revisited, and what are some of the kind of the best practices that you've seen relative to kind of keeping those policies fresh and relevant given changing conditions, both political and economic?
Great question. I think being flexible and adaptive is recommended. We have a lot of agencies that set up pension funding policies a couple of years ago. Things have changed. A lot of times the shape has changed because of a lot of the volatility in the marketplace. So some of the things built into the policy, like targets for the 115 trust, things like that have changed. And I think it's important to stay flexible and adjust the pension funding policy if need be. And I think it also goes to the importance of making this a very, open process with your stakeholders so that they understand why things are needing to change, because of course this is all subject to assumption changes as well as investment performance by the retirement plan. So definitely highly recommend checking in each year to make sure that your pension funding policy is kind of sufficient for your overall sustainability goals.
Mike, if I could throw
I'm sorry, go ahead, Todd. Sorry.
Just on the first question, I was just going to make one more comment. I think Mike explained it beautifully, but the one thing to add would be when we see investment returns that are better than expected, which I think was the first question, CalPERS employs what they call this ramp up period, and we talked about that last week. So if you're in the session last week, you saw that. But basically, the investment return gets recognized. It hits the contribution rates 1/5 at a time. So as Mike said, there's going to be this credit layer, which is going to help offset some of the charge layers when you have good investment return. But you're only going to see about 1/5 of that experience in the first year, and over the next 5 years, that's going to ramp up to a full credit. So they give this smoothing because we see a lot of investment volatility. So whenever there's a charge, a loss or a gain on investments, they do kind of ramp that up over a 5-year period of time. So it doesn't hit instantly in full. It takes a bit of time.
All right, thank you. So another question, this is an interesting one. Is there a better time of year to make an ADP? Is timing important?
It's a great question. I didn't go into this because it's a little bit nuanced. I know more about how CalPERS treats ADPs, and this became much more important when pension bonds were being issued because of the size of the ADP, but you aren't really getting, it's not real time market timing. So what happens with CalPERS is that they will end the year, and let's say they have a negative 10%, they will actually apply those returns to your ADP money based on how much time it was with the fund during the year. And so what it really means is that if CalPERS is having let's say a very bad year, down -5%, -10%, it may make sense to wait on that ADP till, let's say, June, so that you're not getting those losses kind of credited on that amount. On the flip side, if they're having a great year, the more time that money's with CalPERS during the fiscal year, you're going to get more credit for that. So again, a little bit more applicable during the wave of pension bonds, but that is something to consider. The hard part is no one has a crystal ball, and if they're having a stable year, I'd say it just, I would look towards more when you want those new payments to change. So as I mentioned earlier, if you want to see the impact of that ADP starting in the next fiscal year with lower payments, you want to get that money in by about the second, third week of June if it's with CalPERS.
One additional thing to add there as well is with CalPERS in particular, plans are treated differently whether you're pooled or non-pooled and how you get the credit. I mean, you're still going to get the credit of the contribution of the ADP either way, but the mechanics of that, the way the mechanics work is a bit different, whether you're a small agency in a pooled plan or if you're a large agency, which is independent from the rest of the agencies. So that if you're more interested in that discussion, it's worth having a conversation with your actuary at CalPERS because they can walk you through that.
Okay, so we will move into the next section of the session here, the introduction of our case studies on how pension management strategies were applied in the case of 3 different agencies facing very different circumstances. Here today to walk us through their experience and approach is Tabitha Miller. Tabitha joined the City of Arcata as Finance Director in early 2023. She is a licensed CPA and attorney in Washington State with 24 years of municipal experience, most of that in governmental accounting, budgeting, and financial management. This includes service as the Chief Financial Officer for Humboldt County and the City Manager of Fort Bragg. Joining Lori this morning is Lori Zeller. Lori is the Deputy Chief of the Administration and Support Bureau of the Orange County Fire Authority. Lori has been with the Fire Authority for 26 years, holding various financial and administrative positions, including Assistant Treasurer, and Assistant Chief of Business Services. In Lori's current role, she's responsible for all administrative and support functions for the Fire Authority, including finance and human resources, among many others. Then to get us started and begin the case study portion of the program is Edward Enriquez. Edward is the Assistant City Manager, Chief Financial Officer, and Treasurer for the City of Riverside, and has been with the city since 2012. In Edward's roles, he has oversight of the city's $1.3 billion budget, a $2 billion debt portfolio, all financial accounting and reporting, and the city's $1.1 billion investment portfolio. Edward, we'll begin with your case study. Thank you. You might be muted, Edward. So Edward, I don't think we can hear you. Can you check to make sure you're not muted? I think it looks like you're on.
How's that?
Much, much better. Thank you, Edward.
Okay. Yeah, I'm not sure what happened. It wasn't muted. Okay. My apologies. Good morning, everybody. So quickly go through the City of Riverside's pension liability management approach, and it was a long process for us. It's going to be different from, I think, agency to agency, but I think this might give you a good perspective of how we, the city, are tackling this ongoing issue. Next slide, please. So it really started in 2018 with what we term the CalPERS Challenge Project. There was a team of 6 of us that met on a weekly basis, staff from the city manager's office, human resources, and of course, finance staff, to start discussing this issue in earnest, looking at opportunities to address the pension issues, really define what those problems are, break it down to the basics, because what we had intended on doing was educating not just ourselves, but everybody else that is impacted by this. So we involved, we had an ad hoc committee from our Budget Engagement Commission that was interested in understanding the issue. They didn't provide a lot of value in the meetings, but they wanted to know and understand, because they would recommend certain things that ultimately would come out of our internal discussions on how to address this large issue of pensions. At that time, the city had an unfunded liability of over $600 million. It was continually growing. The city manager at the time wanted to take what we had learned, put together the cost management strategies and options, and have brown bag lunches with staff in the city to really highlight what the issue is, so everybody knew exactly what we were looking at in terms of the complexity and the challenges facing the city in the coming years as it related to this growing liability. So there's a lot of education through that process. There's a lot of ideas that came up that we thought about. There's a lot of Q&A, but ultimately we talked about our strategies going forward. And as a result of that, we also had a lot of external meetings with committee members, city council. We put together a very comprehensive web page, which you'll see the address there, dedicated to the CalPERS Challenge. Next slide, please. So the CalPERS Challenge website really contained all of our external discussions, committee, council meetings. You see there's well over 27 meetings. We went through a painstaking process of educating everyone outside the city staff about the CalPERS Challenge, what we were looking at, what were the implications if we did nothing, and what we could do to mitigate some of the ongoing costs. And some initial things we did were, when we had a good year in fiscal 18, some surplus, we set that aside, and we developed Section 115 trust, which was part of a pension funding policy that we started as a result of the CalPERS Challenge project. That pension trust is instrumental for us to mitigate long-term impacts to the liability, and we'll talk about that later. There's also an FAQ there, really basic questions that staff had because they had no idea. They just knew that they had a pension at some point coming to them. So we try to break it down to really basics for everybody so that they can understand what it meant to be in CalPERS, what the CalPERS Challenge was, what UAL was. And there's a lot of good information in there. If you're looking for some information, I know there's a city not too far from us that actually took our website and pretty much copied it verbatim onto their website, which is fine. None of this is proprietary information. We're happy to help. But it was good for us to be able to educate folks and have them at any point in time submit questions through that portal and see questions and answers, and then all the discussions we had with councils and committees on this particular issue and how we were going to go about mitigating the UAL. Next slide, please. So it really boiled down to, after we got through all the internal strategies that we can think of, we really looked at a pension obligation bond as a potential opportunity. I can tell you at the onset, I wasn't really in favor of, but nor was I completely on board. I was on the fence about a pension bond. The city in 2004 and 5 issued pension bonds way before my time. So as part of our analysis when we did a pension bond, we actually looked at how those performed over the last, at that time, 14 years. And they actually performed pretty well. They saved the city about $50 million. So when we got into the pension bond discussion, I wanted to really look at what size do we really need, and how do we target that? How do we target these UAL layers? As I described them to people, it's really every year there's a new mortgage that gets added to your bill, and most of the time it's negative, sometimes it's positive. Which one should we take out? I didn't think it was vitally important for the city to take out the entire UAL of 600, at that time, 632 million. I thought anything north of 85% funding would be sufficient, and we could deal with that delta of 15% through some other budgetary management processes and strategies. So we settled on 2/3 of 432 million to pay off part of that UAL. And we also looked at the payment shape or the payment schedule. I didn't want to kick the can down the road with these bonds. With any bonds, you can structure them however you want, interest only the first few years, and push all the principal back towards the end and just let those issues be somebody else's problem. I did not want to do that. I wanted to make sure that we had a very thoughtful approach to it. We did want some savings in the first couple of years. The general fund did experience about $15 million in savings, which was beneficial. And then I wanted to have a level payment structure somewhat mirroring what our UAL payments might look like on the back end, where they tailor off due to the fact that you have more PEPRA members at that point in time, like 15 years down the road, who theoretically cost less from a pension perspective. So we thought about the shape. I thought about the shape. There's a bunch of ways you can do it, but we settled on a very, really thoughtful approach to how we wanted to do it and not kicking the can down the road. And it's projected to save the city about $180 million over the life of the bond. And all that really is predicated on how CalPERS performs over the life of that bond issuance. We did make sure, as I educated myself and the team on the risks, I thought it was important to look at as many type of scenarios as possible, what ifs, and really put our MA, which Mike Meyer was really instrumental in helping us through this process with our underwriters to understand where the problem areas might be. What if we had a negative return of 5%, what that might look like, and how long we could sustain that. So we did a lot of different scenarios and cash flows. I wanted to make sure that everyone was aware of the risks as we move forward, because these are not without risks. And we also issued the bond at a very difficult time at the onset of the pandemic. As you might be aware, a lot of things stopped. A lot of the bond market stopped for a while. And I think we were one of the first folks to come to market after the bond market opened up. And we were fairly successful issuing our bonds in June of 2020. Next slide, please. We also looked at mitigating that risk as part of the different scenarios. What could we do to mitigate the risk? And we firmed up our pension funding policy, which really started with us developing a Section 115 trust. But within that, we also buried into it other requirements that council is fully on board with, and that had to do with the use of one-time revenues. As we got one-time revenues, we are directing 50% of those one-time revenues to the 115 trust. And other mitigating strategies, when we renegotiate certain contracts, there's some cost savings, we will direct that to the 115 trust. And anytime there's other opportunities for the city, if revenues outperform expenses and we have some surplus, we're redirecting a significant portion of that to the 115 trust to help us out. We also wanted a prepayment flexibility in the bond. The GFOA, as Mike mentioned, has an advisory that really is somewhat opposed to this process for various reasons. And we actually identified and went through each point in that advisory to say, we're not doing this, we're not doing that, and we are having a 10-year call because we want that flexibility. Our total interest cost, I believe, on the bond was about 3.8%, which was pretty good at that time during the pandemic. So it was pretty comfortable issuing it. A little nerve-wracking at that time, but it has turned out to be very frugal timing for us. We did a lot of, I can't overemphasize this enough, a lot of stakeholder engagement and participation, a lot of education of folks. We educated ourselves. I was fairly familiar with pensions before dealing with actuaries as a former auditor. So I have a lot more familiar than anyone else, but we did some more education in finding that champion within your council, your board is helpful. I had a finance director who understood numbers. I met with him quite frequently so that he got comfortable and he could champion it from the dais. But really having those ongoing conversations about the challenges, being open, transparent, and honest about it, turned out to be very positive for us as we moved through a very difficult time. There was a lot of folks in the community who were against it, but ultimately it was a unanimous decision by council to move forward with the bond. Next slide, please. So post-bond issuance, we have a multi-pronged approach to addressing the remaining UAL, which is very volatile, which is one of the reasons why I didn't think doing 100% takedown of the UAL made sense to me in our situation, because there is that variability every year. There's volatility, as you saw in 21 with great returns, in 22 with not so great returns, are really bad returns, in 23 subpar returns. So after POB issued, we had a remaining UAL of 230 million. That resulted in a pension holiday actually this year for us. We reserved funded 100% on our miscellaneous, but what we did and incorporated this into our pension funding policy is we took those, what we had programmed in the budget in previous years, took that payment and put it into the 115 trust. So we didn't take a full holiday, we just redirected those payments. The other thing we do, and that happened this last year too, is any debt that matures, and this is part of our policy, any debt in the general fund that matures, such as a pension bond that dropped off in 23, we're reprogramming those payments this year to the 115 trust. So this year we have about $22 million going into 115 trust because of debt maturity and the pension holiday that we got due to the overfunding as a result of 21 returns. And fast forward to 22, terrible year. The UAL jumped up to 350 million. I hate to think what it would be without a pension bond and how we could address it. Fixing that component of 432 million I thought was beneficial for us. We could have budget certainty and then deal with the remaining portion through 115 trust and other cost mitigation strategies. So our plan is to grow the trust to about $100 million through a combination of contributions and interest growth. And we're fortunate now that we have some fairly good returns in interest. And we have a pension smoothing policy where we know what really our cap is, what we'd be comfortable with in pension contributions. And once, from a budgetary perspective, our contributions start going past that threshold, we will begin drawing down on the 115 trust to give us that certainty in our budgets and consistency. And we believe that's about 4 to 5 years away when we start drawing on the trust, and then it peaks about 5 years after that, theoretically, based on the math, and then tapers off after that. So I think there's like a 5 to 7 year period where we'll have some added pressures, but I'm comfortable with continued contribution to the trust that we can mitigate the remaining portion of the UAL by just doing this smoothing process with the 115 trust contributions. We do on an annual basis, a couple times a year, talk with our MA, Mike at NHA, Mike Meyer, to look at the structure of our UAL and look for opportunities. Might be an opportunity to make a ADP one-time payment on things. And we frequently talk to our CalPERS actuaries. So if you don't know yours, you should get to know them, because ours is very helpful, provides a lot of data. I ask some questions and scenarios, and they're happy to run it. I would encourage you, if you don't have a relationship with your actuary from CalPERS, do so. And I also encourage you to get your own actuary to do your own analysis as well, to provide additional clarity and education for yourself. Next slide, please. So with the using our POB savings and 115 trust, we're really trying to smooth out. You see the peaks there in yellow, which is the projected UAL payments. We also use the CalPERS Pension Outlook tool quite frequently. I use it for budgetary purposes before CalPERS sends me the report, just to see what the payments will look like. But we're trying to smooth out those yellow bar peaks there, and our threshold is about $54 million or so in contributions. Above that, we're going to start drawing on the trust to level off our payments and give us budget certainty and alleviate those peaks. But you see there where we deposited money into the trust to help us grow over the next 4 or 5 years, at which point we'll stop, and then we'll just start relying on the trust to help us smooth out our payments. And anytime we have a bond that matures, as it did in 2023, we add that to the trust. So you can see there, the bottom looks like it's, for me, it's dark green, is our current POB structure. Again, I didn't want to handcuff folks on the back end. So a small bell-shaped curve in terms of our structure, because I knew we had some pressures when we started this process back in 2018, had some budgetary pressures, CalPERS challenge pressures. So I needed a little more savings up front, but I wasn't going to do it at the risk of the back end. So everybody has a different approach. You should analyze your specific situation, but for us, this worked. And utilizing the trust and savings, I think we could mitigate that volatile component of the remaining UAL that's outstanding. Next slide. So for us, it's always an ongoing discussion for us internally, externally as well. Council, we give an update. We continue to have the multi-pronged approach to addressing the UAL. We give annual updates about the pension bonds and how they're performing. We do an annual analysis. We do have a pension funding policy, again, that dictates 50% of one-time monies, and any annual surplus gets directed to the 115 trust. And we were pretty fortunate with the pandemic that we were impacted positively on our revenues that helped us build up that trust even more. Just fortunate timing, unfortunate situation, but fortunate timing. And then as bonds mature, we redirect those payments that have gone away, theoretically from a budget perspective, rebudget those to the 115 trust to continue to build up that. We use the 115 trust savings, which is close to about 60 million, along with the POB timing and fortunate strong economy. Again, with the pandemic, our revenues increased over a 2-year period about 35%. We hope to grow it to about $100 million, and then use that to mitigate those out years as we have additional pressures due to UAL spikes in payments. And of course, ongoing with our advisor, we're looking at the current UAL structure. Every year the CalPERS evaluation will come out, look at the structure, see if there's anything we can do differently, maybe restart, and looking at ADPs. At this point, I'm comfortable with what we've done, what we're planning on doing with our 115 trust pension smoothing. But each situation, scenario, and organization is different. So for you, it maybe makes sense to take out a layer, but work with your advisor, work with CalPERS, because they will help you through this process. Next slide. Yep.
All right, well, thank you, Edward. We're going to move on next to Lori Zeller. Lori?
Good morning, thank you. I'm Lori Zeller, Deputy Chief with the Orange County Fire Authority. And before I get into my case study, I'm going to give you just a little bit of background about OCFA. We are a joint powers authority, which means we have multiple agencies joined together to jointly exercise powers to deliver services. In our case, those services are fire and emergency. Our JPA includes 23 cities from within Orange County and all of the unincorporated areas of the county. And they're governed by an elected member from each of those agencies. So with one elected official from each of the 23 cities plus 2 from the county, we have a total board of directors that is comprised of 25 members. We have 1,500 employees that are represented by 4 separate unions, with the largest being the firefighter union. And all of that just provides some background as to the complexity of the organization, which contributes to some of the challenges that we had to face as we were developing our own pension paydown plan. Next slide, please. So as we were developing our policy for managing our pension liability, the key factors that we were looking at were motivating factors. Why was this important to us? The timing and opportunity, is this the right time? And then we needed to build a strategic vision. How would we go about this, and what would it look like when we got to the end state? And ultimately, probably most importantly, we needed to look at stakeholder support. Do we have collaboration for success? Without that, there was no chance that we were going to be able to make this happen. And I think those are similar factors that really any agency would need to look at as they put together a proactive pension liability management plan. Next slide, please. So the first of those factors being the motivating factors. For us at OCFA, we were looking at this post-recession 2012. That was our primary motivating factor. The funding level for our pension plan had declined to only 61%, and that was driven primarily by impacts from the recession. We had significant market losses in 2008. We're in OSERS, which is a county 37 Act system, and OSERS at that point in time, 2008, lost over 20%. So a huge impact on our unfunded liability. And that was building on what we already had as unfunded liability resulting from benefit enhancements that had gone into place with 3 at 50 for safety members. Had a very large impact on us in the early 2000s, magnified then with the 2008 market losses. And at the same time, we were navigating other recessionary impacts. We had had a sharp decline in our revenue. We're largely property tax funded, and that had dropped sharply. And at the same time, our required contributions to the pension were going up at a significant pace. So trying to manage both of those competing pressures were having a lot of impact on our finances. So to get through that, we had several different fiscal management actions that we put into place. We had to open up all of our labor contracts with our associations. We had our employees agree to give backs to avoid service reductions and layoffs. And so by doing that, we were able to get through the recession, but not without pain and not without an impact on all of our employees, which created collectively, it put management, labor, and our governing board all together with motivation to stabilize the pension plan, with the ultimate goal to improve our finances and sustain, and even better, improve service delivery over the long haul. Next slide, please. So with those strong motivating factors as our foundation, our next step was to leverage the timing and opportunity that we had in front of us. The timing for us when we were working on this around 2012, we were facing the PEPRA to be implemented. Pension reform was going to become effective in 2013. And we knew that that was going to lower our pension contribution costs over the long haul. As we got new employees on board, those future contributions would go down. which presented an opportunity, though it would be slow and take time for it to play in. That was a good opportunity. And then the timing resulting from the need to restore budget cuts. We had so many cutbacks we had made during the recession. Over 100 support positions got frozen to be able to get through that. And all of that had to be restored. We had stopped training, we had slowed down on academies, we had frozen positions, all of which needed somehow to be phased back into our finances. So we were presented with the opportunity at the timing of the fact that we were building a whole new baseline for our future finances, and the timing for how we were going to phase in the reductions that we had put in place essentially gave us a good sort of a new baseline to build in a proactive pension management strategy at the exact same time as we were building that new baseline. Next slide, please. So that led us to what our strategic vision was. And you'll hear me talk often about our pension paydown plan as a snowball plan. And this was adopted in 2013. It was a multifaceted plan that was intended to accelerate the paydown of our pension liability. So this was a voluntary plan. It's not something that we embedded into OSERS, but it was built so that we would maintain the flexibility and control, yet be very dedicated to making it happen. And in concept, what the plan was that we would allocate extra payments towards the unfunded pension liability, initially starting in very small amounts and then building to sizable payments over time as we move forward. With that, every extra dollar that was generated in interest savings would lower our required pension contributions, and we would capture all of those funds and contribute that as additional dollars towards the pension liability, which was just continuously accelerating the pay down. Because of that, that created the snowball effect in which the interest savings and the resulting gains towards paying down pension liability just kept growing larger over time, which is the snowball effect. Next slide, please. So to show you sort of what we were looking at, this chart that we have here is essentially what was presented to our board when they adopted the snowball plan back in 2013. The first element being capturing the savings from PEPRA. We had long-term projected retirement contribution rates that the OSERS system and the actuaries had given us before PEPRA. And then we had the assumptions they had made as we would bring new employees on that would be under the lower benefit tiers with lower retirement costs, what those new rates would be over the next many, many years. We had 20-year projections. So what you see on the right is if we run out those prior projections and then compare it to the new projections, every dollar in savings between those two lines would be captured and essentially hard-coded into our future finances as dollars that were going to be dedicated toward paying down our pension liability. And when I say we captured those and hard-coded them, that was important because there's so many factors constantly changing that impact our future retirement costs that are unrelated to PEPRA. So you're going to have mortality changes, you're going to have interest rate savings, you're going to have actual experience changes. And those savings could have just vaporized by getting sucked up by those other elements. So we were committed to grabbing these projected dollars, rolling them into our financial plans, and staying committed to them no matter what other elements changed and came at us in the future years. So this was probably the largest component. You can see how long it took. Those dollars were small in the initial years. And even now, as we're approaching the next couple of years, you can see the 24, 25, 25, 26 period of time is where those dollars really get very large, and we're definitely reaping the benefits of it now. So to bridge that period of time while we were waiting for those really to kick in, we also had an additional element, which was to introduce an annual expenditure into our budget. Again, starting small and growing bigger over time. It started initially at $1 million per year, and then we would add $2 million to that every year until we would get to a level amount of $15 million and hold it at that. And you'll be able to see in another slide what that looks like today. And then finally, and this was probably the less impactful, but it was something that had benefits now and then, was to allocate any year-end fund balance that we would have. Long-term average for us would be about $3 million per year. That could be a combination of dollars saved, expenditures didn't come in as high as what we had thought when we built the budget, or revenue came in higher. Combination of those, we had estimated about $3 million per year, but sometimes would be quite a bit higher, sometimes not at all. Next slide, please. So this is what it looks like now, essentially today. This is from the most recent budget presentation that we made to our board. These are the key elements of that snowball plan. So going across the bottom, those are essentially the mortgage. That's what we have to pay to OSERS. Those are our required amortization payments to pay down our pension liability. And then everything stacked on top of that are the snowball plan, the voluntary dollars. So collectively, when you look at this window of time, you'll see if you added those dollars up, you're going to see about 200 million, a little bit more than 200 million in required payments, and an additional 172 million in voluntary payments. So close to doubling what we're being required to pay. The orange through the middle is the rate reductions from PEPRA. So remember I mentioned that you really see to get the sizable benefit from those don't kick in until the later years. And you can see that here when you approach the 2025, 2026 period of time, that's really jumping and now producing much greater dollars that are going towards a snowball plan. So what bridged that period of time is the pink stack on top. That's the one that started 1 million a year and then grew by 2 million a year until it hit 15 million. And we just hit that $15 million threshold this fiscal year. So you can see that that really accelerated us to get there while we were waiting for the PEPRA benefits to kick in. Next slide, please. And so what it has meant for us in results is just a continuous steady improvement towards our percentage funded. When we started looking at this, like I said, in 2012, we were just barely over 60% funded. And we've seen that through the most recent year end of 2022 grow to 93.74% funding. So what we view is just tremendous, very successful results. And that's in spite of some years of pretty negative experience factors that were coming at us. For example, in 2017, the pension system, OSERS, lowered its assumed interest rate, its assumed rate of return from 7.25% down to 7%. They also made some pretty significant changes in mortality that otherwise should have, those factors alone really should have driven our percentage funded down, yet we still had a percentage increase that year in our results. And then most recently in 2022, we saw a negative return in the market impacting the pension system, yet we still had a gain. Again, those are going to be smoothed over time, so we'll be dealing with that for the next 5 years. But no matter what has come at us, we've seen a pretty steady improvement in our percentage funded. Next slide, please. And then when we talk about the snowball element, this is probably the best way to demonstrate the benefits and the results that we've seen. Every year we provide our actuary, which is the Siegel company, how we're doing with our pension plan. We give them the dollars that we're contributing, what we're projecting to continue contributing into the future, and they run what we have gained as far as interest savings because of the extra dollars that we've paid. And you can see it started slow in the beginning. First year interest savings a little over $1 million, and then it just started really growing every year to 14 million as of the most recent year in 2022, for a total saved over that period of time, 60.8 million. And then just very recently, we got our update for the current year that adds in the additional savings for most recent year of 15.9 million. So we're now at 76 million in interest saved. And those dollars just continue to perpetuate, accelerate our pension pay down. We're very pleased with those results. Next slide, please. So the final factor is stakeholder support, which probably was the most important element for us to be able to get this approved by our board. And it's really been an evolution over the entire 10-year period that we've had this policy in place. It was adopted by our board in 2013. We talked about that we had management, labor, and the board all on the same page with the goal of stabilizing our pension plan, which would also then stabilize our finances and enable us to continue our services to the community. And so we did that with support from our firefighters union, really all of our unions. But again, I talked about our firefighter union being the largest group that we have. We had support from them, and we had them standing at the podium providing their words of support to the board and recommending that the board approve it. And I have just a quick slide to demonstrate the comments that our firefighter union president made. If you can go to the video, please.
Good evening, board members. Thanks again for the opportunity to speak. The Orange County Professional Firefighters have reviewed and support the proposal in front of you that begins to address the unfunded liability in our retirement system. We understand that this important issue needs to be addressed and feel the proposal before you moves us towards meeting those retirement obligations. We further understand the importance to work collectively to stabilize the retirement benefits that our people have been promised and we are counting on. Taking into account all these considerations, we assure you that we are committed to fixing the problem. We are committed to ensuring that the funds are available to provide the benefits we have promised our people, and will work with the OCFA to stabilize this issue and meet our obligations through ongoing discussions in the upcoming negotiations. It is in both of our best interests to make the organization stable, live up to our commitments without sacrificing service to the public. We support the proposal outlined and urge the board to adopt it. Thank you.
So with that, we really consider that a remarkable dynamic that helped us to get this approved. Understanding that millions of future unallocated budgetary dollars were going to be dedicated towards this, having our union stand side by side with us for support was a key factor to making this happen. And then we've continued to evolve this plan. In the time that we've had it in place, our board has continued to develop it with our support. In 2017, they added a secondary goal that once we took our core pension to a funding level of 85%, we would rededicate those snowball dollars to an OPEB liability, our retiree medical plan. It was significantly underfunded, and we needed to be able to have funds go to that. So that has started to happen at this point in time. Next slide, please. There we go. And then in 2018, this was a really big step. Our board of directors decided to amend our Joint Powers Authority Agreement, which is essentially our foundational governing document. It drives the things that must be done for this organization, and it can only be amended by going in front of all of our individual member agencies. So whereas a normal policy action can be approved by our 25-member board of directors, in this case, this policy action had to go in front of the 5 council members for each of the cities, as well as the county board of supervisors to get approved. So it was a monumental action, and once it was done, it can only be undone by then going in front of all of those city councils again to take it out. The board wanted to do this because they wanted to show their commitment, dedication. They didn't want future governing bodies to come in and undo the progress that they had made. They wanted to really memorialize that commitment into our foundational JPA document. Next slide, please. And finally, to where we are today with 2023. In our most recent budget presentation and update on our snowball plan, we talked with the board about the success that we've realized from this plan, showed them the same numbers I've shown you. And we have a quick little video clip where they talk about that. If we can go to that video, please.
Directors, do you have comments related to this matter? Please.
Just a quick comment. A big thanks to all of you on this work. One of the big reasons Garden Grove is here is because of the work that this board, previous board and your staff has done on unfunded liability. Before Garden Grove came to the Fire Authority, we were seeing CalPERS exponentially quadrupling over the next 10 to 20 years. And when I saw what you were doing here, it was a huge factor in Garden Grove coming over because we're saving money. Even when our cap is at 4.3 because of a pandemic or because of MOUs, I feel we're still saving money in Garden Grove because of the work we've done on the unfunded liability. Sure, we still have unfunded liability for everyone that was with Garden Grove. We're still paying that down over there in Garden Grove. But for a city like ours, almost 200,000 people, 25 million a year in fire service, it's with the work you've done on the unfunded liability is just, it's almost unbelievable. I can't believe it. So it's great. I think we need to keep focused on that and pay it as you go as we move forward. I'm excited for 26, 27 when that's paid off. So thank you.
It looks like the organization is really well managed from a fiscal standpoint and looking good for the taxpayers into the future. So thank you.
All right, and so that concludes my presentation. Thank you.
Thank you, Lori. We're going to move on to Tabitha Miller's case study. I will recognize that we're getting very close to the bottom of the hour, so we're going to run over just a few minutes. We want to hear Tabitha's case study, and then we'll wrap it up. But if you could hang in there with us for just a few more minutes, this is a great story. So, Tabitha?
Thank you. I am Tabitha Miller. I am the finance director currently for the city of Arcata, and I have been here just since January. I'm going to go ahead and have us move to skip this slide and move to the next one just because we were pressed for time, and I want to try to keep us as close to that deadline as possible. So something that was very interesting, I had gone through a process with the city of Fort Bragg as far as issuing bonds, setting up policies, and really implementing a pension management program. And when I started with Arcata in January, very little had been done aside from back in 2015 issuing a small POB side fund debt issuance to sort of stabilize or maintain those payments. So we were really coming in fresh, and it felt like we were a little bit behind the 8 ball. Certainly when you listen to our last 2 case studies, we are coming at this as a small town and also fresh to it. So we've sort of streamlined it and pushed forward pretty quickly. One of the first things that we did that was really important was to educate our new city council. They had only been, the longest term was 2020. And so we started with a series of a couple educational sessions with GovInvest, and I'm sure most of you have worked with them or aware of what they do. And really during that education program, we had some real strong goals. And one of them was to make sure that our council understood the magnitude of our $30 million UAL, which for a city our size is pretty big. To put it in perspective, our debt, all of our other debt is less than $3 million. The second piece we wanted to make sure that they really understood was the cost of that debt, and that the 6.8% interest that we're paying on our UAL, is higher than any of our other debt. The third thing we wanted to make sure they understood was that this was going to be the long term, that it wasn't that we could make some dents in it in a 1-year period and in initial kickstarting of our program, but that we had to try to commit as a city for the longer term. So that was really important to us. And then finally, fiscal sustainability. You know, we're a small city, small funds. We're a little more at the discretion of the volatility of ups and downs, fires, pandemics, those sorts of things. So it was important that the council understand that we could afford to do this and start planning on how we could do that, and which really led the council to support sort of an ongoing interactive process that we'll talk about a little bit on our second slide. So one of the things we were able to do is we found 2 sources of initial funding for kickstarting our program. One is that we have about $1.5 million in an internal OPEB account that had just sort of built up over time. And it's not that our OPEB isn't important, but we felt like repurposing those funds towards the pension that had certainly a much higher actual interest rate and a much bigger impact on our annual pension expenses was the way to go. The second thing is that, like one of the other, like Riverside, we as a city really benefited from the pandemic, and that's a horrible thing to say. But between the fiscal year ending 2020 and this year, the fiscal year ending 2023, we have doubled the size of our fund balance. We've gone from about $7.6 million in our general fund. Our expenses are about 16 to 18 million a year to $15.5 million. So we've been able to set aside some money. In addition to that, both our water and sewer enterprise funds have been able to build up some surpluses that we're using to pay down their portion. Next slide, please. So we're kind of taking the all-in, throw everything at our initial strategy. So all of the things that Mike has talked about, with the exception of pension obligation bonds, which really the timing isn't right, we're implementing, and we're doing it because we really want to make sure that we have all of those tools in place going forward, and that the city is committed and we keep this on the radar. So the first thing we're able to do is we were able to take $5 million from some of those fund balance amounts that have been built up over time, and we're going to make an additional discretionary payment directly to CalPERS. And this really allows us a couple things. One, it decreases our $30 million UAL by about 18%, which is a big chunk of money for us. It also allows us to really do that fresh start. And as Mike said earlier, I was a little surprised by how few entities are using the what we're calling the hard fresh start. But it's important to our council because it's a commitment. It's somewhat like doing POBs or other debt where you're committing future councils. We're really committing to make sure that we pay this off. So we're taking the 15-year formal fresh start. And then in addition to that, we're going to take that $1.5 million that's setting aside in that OPEB trust on our side invested in LAIF. And we're going to use that over 5 years to pay down, to basically try to pay this down as a soft fresh start in 10 years to really reduce that cost. And that gives us about $2.4 million in savings. That's on top of the $5 million we'll get from the ADP. So we're really starting to cut that. We're getting a big bang in this first year. So the final thing that we did as far as the pension program is we implemented a pension funding policy. And a couple points that we made that we wanted to make sure that we did, they look very much like many of the other agencies out there as far as what we're doing. We've committed 25% of any surplus in our general fund to either a contribution to Section 115 or to an additional discretionary payment. But we've built it in so that we have to go through that process as part of the budget process so that we really recognize the cost of the expense on an annual basis, what the savings means to us, and that we really try to, in addition to that 25% of surplus, make additional contributions and keep it fresh and keep it out in front of the city councils and the public and staff's view every year. One final item that we did just to kind of reassure our city council and our constituents, we bumped our general fund reserve policy from 25% of our general fund operating to 30% this last year. And again, we're really trying to create that sense of resiliency and stability that resonates in our community as far as being able to maintain where we're at. Go ahead and move to the next slide, although I think this has probably already been hit. So we've really gone through our funding highlights here, but again, just wanted to point out that this was really important to sort of memorialize where we're at and what we're doing. And I know we're 7 minutes over, so with that, Robert, I'll turn it back over to you.
Thank you, Tabitha. Now, we had planned a Q&A session here. It doesn't look like we have any questions that have come in except for one for Lori, and that is additional payments. Did you apply those primarily to interest or the principal, or could you evenly split them?
We would just send them to OSERS as additional contributions towards the system. We would have them split them between our safety, our firefighter group, as well as our non-safety professional staff group. It had the effect of avoiding interest payments essentially, but we didn't provide any direction whether to apply it to principal or interest.
I can give a little further information if desired, and that is OCFA was already fully covering the interest on their funded liability through their normal contributions. So all of the additional payments were going towards principal.
Okay. Well, we're running over. So as we already discussed, we would like to be able to field your questions. If you do have other questions, again, none have been submitted into the session, but feel free to follow up with CDIAC in the survey that follows, and we'll get those questions answered for you. We like to make sure that we do get responses back to you. So that's going to close out our session. Thank you for hanging in with us a little bit late. Before we sign off, first, a very large thank you to Todd Towser and Mike Meyer for another expertly developed and delivered session this morning. Thank you to Edward Enriquez, Lori Zeller, and Tabitha Miller for giving us your time to share with all of us your experience in putting together your strategies and putting them successfully into practice. Before we sign off, I'd like to quickly draw your attention to a couple of upcoming CDIAC programs. On September 19th, we'll be presenting another webinar on green bond disclosure and reporting expectations of issuers and investors. Then on October 19th, we'll be presenting CDIAC's pre-conference to the Bond Buyer California Public Finance Conference in San Francisco. There we'll be talking about managing borrowing costs given the current conditions in the municipal market. Full program and registration information for those are on our website. Then I want to remind you all of CDIAC's Elect Ed program, which is available through our education portal. There was a great deal of case study discussion about the need to educate and inform elected officials to kind of provide a baseline understanding of pension and public finance subject matter. CDIAC has developed tools to help you as you build that understanding and support for your pension management strategies. We developed, in collaboration with Todd Towser, by the way, 2 on-demand modules on pension fundamentals and management specifically designed for elected officials. And then we also have 6, soon to be 7, on-demand modules on debt issuance and administration. These are concise, convenient, and enjoyable, and free to access. So as I've mentioned, the replays also will be available in a couple of weeks. So a lot of tools for you to help in that education effort. So please reach out to us if you have any questions on our Elect Ed program or our education portal. Finally, we'd like to get your feedback, as I mentioned, and those questions. Please spend just a few minutes and tell us what you think. It's all very helpful and appreciated by all of us. You'll be getting a survey just shortly after the program here. So with that, on behalf of Mike Meyer, Todd Towser, Edward Enriquez, Lori Zeller, and Tabitha Miller, and all of us here at CDIAC, including our hardworking education team that brought you this program this morning, Angela Ayala and Anna Ramirez, thank you all very much for joining us, and have a great day.